These are the Simplify Next Intangible Index ETFs. Simplify Next Intangible Core Index ETF, ticker symbol NXTI, and Simplify Next Intangible Value Index ETF, ticker symbol NXTV. In this video, we'll discuss what is intangible capital, why intangible capital is important, how the indexes are constructed, and portfolio use cases. While some investors may not be familiar with intangible capital, most are probably familiar with tangible capital. Tangible capital refers to assets that are listed on a company's balance sheet. Tangible capital will appear under the book value calculation. Examples of tangible capital include things like property, machinery, and other types of equipment. Unlike tangible assets, intangible capital often does not appear on a company's balance sheet and thus is mostly absent from the book value calculation. Intangible capital can be placed into three primary categories: knowledge, which includes investments such as research and development, patents, code, or trade secrets; brand, which includes items such as logos, trademarks, corporate identity, or social media presence; and organizational capital, which includes employee talent, best practices, and corporate culture. These are just some examples of what might be considered intangible capital. Investments in intangible assets can typically be found in a company's selling, general, and administrative expenses, goodwill, or directly identifiable intangible assets such as patents and copyrights. Over time, intangible capital has been replacing tangible capital as a component of stock market value. In 1975, tangible capital represented 83% of stock market value. This component of stock market value has continually diminished over the years and now represents only 10% of stock market value, and yet intangible capital is a metric that continues to be ignored by many investors. Why is intangible capital so powerful? Here's an example. Suppose a company invests in a tangible asset like a new truck. The truck will add value and revenue, but doesn't scale as there is a fixed amount of hours that the truck can operate. On the other hand, an investment in improved supply chain management software can theoretically increase the productivity of every truck in the fleet. The most successful companies over the past few decades have all made significant investments in tangible capital, whether it be through building powerful brands, hiring and retaining the best talent, driving innovation through research, or some combination of these efforts. Now that we've discussed the power of intangible capital, how can investors take advantage of it? This is why the Next Intangible Core Index was created. It selects stocks with high intangible relative to tangible assets. These firms have numerous competitive advantages, including greater returns to scale, higher profitability, higher cash flows, and a greater degree of innovation. Investors can also use the power of intangible capital to improve value investing. Most value indexes begin by selecting stocks with low price-to-book ratios, a strategy first advocated by Benjamin Graham over 90 years ago. This was during a time when most assets were tangible. What many investors may not know is that traditional value indexes explicitly exclude stocks with high earnings or sales growth. This can result in the inclusion of many value traps, which are stocks that have an appropriately low valuation due to their poor fundamentals. The Next Intangible Value Index also selects stocks with low valuations, but adjusts the book value by including the value of a company's intangible assets. Unlike traditional value indexes, it does not penalize companies with attractive earnings or sales growth. In fact, the opposite is true. A high degree of intangible capital is associated with better fundamentals. Now let's look at how the Next Intangible Indexes are constructed. The core and value indexes both begin with the same investable universe, the largest 2,000 U.S. stocks by market capitalization. The core index ranks these stocks by the ratio of intangible capital to book assets within its own sector. The value index ranks each stock by equity valuations to intangible adjusted book value within its own sector. Each index selects the top 200 stocks by the respective ranking metrics. The stock weighting in each index is determined by its relative market capitalization. The maximum weight per stock at the time of investment is 5%, with a minimum of 5 stocks per sector. The indexes will be reconstituted and rebalanced quarterly. Lastly, the indexes are long only with no leverage. Do the indexes favor high intangible capital industries over high tangible capital industries? For example, biotechnology over construction equipment? No. A biotechnology company and a construction equipment company will not be ranked against each other, but against other companies in the same sector. So a construction equipment company with a high degree of intangible capital relative to its peers could get ranked higher than a company in an intangible heavy industry like biotechnology. How have the indexes performed? Here we can see the growth of $1,000 in the next intangible core index versus a market capitalization weighted index of the top 3,000 stocks going back to 2018. We can see that the core index has consistently added value over the broad market index. This is the growth of $1,000 in the next intangible value index versus the selective US 1000 value index, a traditional book value-based value index since 2018. The intangible value advantage is persistent. Portfolio use cases are simple. NXTI can be a direct replacement for any core U.S. equity fund, whether active or passive. NXTV can be a direct replacement for any U.S. equity value fund, whether active or passive. Now for some Q&A. Why has traditional value investing struggled so much over the past 20 years? Most value indexes use book value as a key valuation metric. As discussed, book value captures a shrinking part of the market's total value. It also minimizes exposures to companies that invest heavily in productivity and innovation. The most successful companies of the past decade all have high degrees of intangible capital. For example, Microsoft, Nvidia, Google, etc. Is using the intangible capital metric just a backdoor way of investing in growth stocks? First, the academic research supporting intangible capital goes back more than a decade. Furthermore, the indexes compare stocks within their own sectors, so an industrial stock is just as likely to be selected as a technology stock. Lastly, the next intangible value index has a strong positive correlation to traditional value indexes, making it a true value index. Will NXTI have a growth bias? A style analysis will show that stocks with high intangible to tangible ratios display some growth characteristics. A major difference is that, unlike growth indices, it does not use valuation as a metric, making it not very highly correlated with growth. If anything, it may be slightly more correlated with quality. What is the difference between NXTI and NXTV? NXTI is a core product that has a goal of outperforming a broad market index, while NXTV is a value product with a goal of outperforming traditional value indexes. NXTI is based on the composition of a firm's capital, intangible versus tangible, while NXTV selects stocks with low intangible adjusted book value ratios. Thank you for viewing this presentation. For more information about these or any other Simplify ETFs, please visit simplify.us. We'd love to hear from you directly, so from the homepage you can hit the Contact Us button to get in touch with us and we'll respond promptly.